Hey guys, it is Julie here with JT Wealth. We are having a red day in the market. So I just wanted to make this video to have a chance to just chat with you guys on my advice on how to handle days like this. So let's get into it. All right, guys, welcome back and thank you so much for being here. First of all, I think we all just need to take a deep breath. There is a lot of red in the market today, and that can cause a lot of stress as we see those big negative signs in our investment portfolios. But I just want to let you guys know we are going to get through this just fine. So I have my glass of red wine, and we are going to chat about how to handle red days like this. To start off, I want to address all of the different terminology to address a day like today. So far, I've been using red day. This just means we're seeing a lot more red versus green on those stock charts. Now, other terms include correction, dip, bear market, or crash. And we are seeing a lot of people talking about a market crash today. All of these terms basically mean a sudden decline or drop in the stock market. However, I try to avoid using the term crash as I think it has a lot of fear-mongering behind it. The stock market by nature expands and contracts. And the good thing is historically, when we have seen these contractions or corrections, we often see a very healthy recovery afterwards. Now, I did do a video similar to this back in September on how to succeed in a bear market, as this was the last time we saw a lot of headlines sprinkled with the possibility of a big downturn. So a lot of the principles in this video are going to be similar. We're going to talk about the emotional aspect to investing, how to stick to your plan, and how to set yourself up for success during market dips like this. Just before we dive into all of that, this is your friendly reminder that if you enjoy today's video, make sure you hit that thumbs up button, that you're subscribed to the channel, and leave your thoughts in the comments down below. Now let's start off talking about the emotional aspect of investing. We all know when we take a look at our portfolio, it's a lot more than just numbers on a screen. This is our hard worked for money that we have put at risk in hopes of growing it into something more. So it hurts a lot when we see that money put at risk and possibly go negative. Now, psychologically, we feel the pain of a loss twice as much as we feel joy from a gain. So keep that in mind the next time you're looking at your investment holdings. It is our human response to want to stop what is hurting us by just cutting those losses and getting out of the market so that we cannot be hurt anymore. But you need to keep in mind that this pain is only temporary. One of the worst things you can do when stocks are down like today is sell your positions and lock in those losses. Quick caveat here that I am coming from the perspective of a long-term investor. I understand for any of you day or swing traders that there are a different set of rules that apply, but I'm discussing people who have investments that they're intending to hold for months and years to come. Now, my favorite analogy for what you should do in a bear market or market downturn is the same as what you would do if you were to see a bear in the woods, and that is play dead. Don't make any sudden moves and remain calm. Fighting back would be dangerous, right? The same can be said for the stock market. Do not panic sell. Stick with your plan and believe in the investments that you made. Now, I want to take a look at some Tesla charts just to show you an example of why you should try to resist the urge to panic sell on a market dip. So if we go back to August, we know that Tesla had some amazing gains, gaining over 80% just between August 11th to the end of the month. But fast forward from there, and between August 31st and September 8th, Tesla took about a 33% dip. So many people might think, oh my goodness, I need to get out. This is dropping. I want to save my money. I'll just get back in at a lower price from there. The problem is you would have never seen a price that low again. So how can an investor make money during market dips like this? Well, I'm not a short seller, so I can't speak from that perspective. But for a long-term investor, I think the smartest thing you can do is to set yourself up for success on the next green day. Now, I think there are two ways that you can accomplish this. First, if you have some extra cash on hand, you can take advantage of some of these lower prices. Buy some of those companies that you have great hopes for while they're considered on sale. The second thing, and the easiest thing to do, is simply nothing. Sit on your hands, sit tight, turn off your computer or your phone, stop looking at all your stocks, and just let them ride out this period of volatility. One thing I often say in my videos is always to make sure that your investment choices fit your risk tolerance and time frame. So I want to break down a bit more what I mean when I say that. Let's start off with time frame, because I think a lot of people get confused on this. They think, oh, hey, I don't need this money for 6 months. That's plenty of time. But that's not the case. When I used to work at the bank, unless you had over 2 to 3 years, you weren't even allowed to be in the most conservative mutual fund. You need several years to ensure that you can ride out any volatility or major corrections in the market. If you don't have that kind of time to let things ride out, or you need that money for something specific in the short term, you probably shouldn't be in the stock market. And I know, I'm sorry that sounds harsh, but if we were to go into a true recession and downturn, it can take years for those markets to ever recover to what they once were. The last thing you want to have to do is withdraw some of your investments when they're at an all-time low because you haven't planned your time frame accordingly. The second thing is risk tolerance. And I know a lot of us think, sure, I'll take on some big risk for big reward, that's fine. But when we see red days like this and we see people start to panic, we find out how true that actually is. One question that we used to ask when determining risk tolerance is, say you invested $100,000 that you plan to leave there for the next few years, but you get your first statement and it has dropped $10,000, so 10%. How would you react? Would you A, pull your investment out and wait for things to recover? B, just leave it alone but not contribute anything further? Or C, buy more investments since it's on sale? If you answered A, that you would pull out your investments and sit in cash until things recovered, your risk tolerance might not be as high as you think. And again, there is nothing wrong with this. You just need to understand so that you can set yourself up for the best possible success with your investments. Which brings me to the importance of diversification. Now, you can be diversified in the broader sense as far as having funds in a stock portfolio, investments in real estate, and just cash on hand, but you can also be diversified within your stock portfolio as well. And this comes down to the type of stocks in your portfolio and how they are going to react to market volatility. People in the tech sector and some more speculative areas today are feeling those hits a bit harder than people in some of the bigger blue chip dividend paying companies. These just react differently, and it's good to have a balance of these in your portfolio to help hedge against some of this volatility. So I know this has been a lot of different things to consider. I think the biggest takeaway is just try to be honest with yourself, understand the investments that you've chosen, and just try not to panic. Market dips, corrections, downturns, whatever you want to call them, they are nothing new, and they certainly aren't going away. They are to be expected in the stock market, and the biggest difference maker is between how you handle them. Just keep in mind that historically, after any major downturn, there has been a healthy period of recovery. Most of us just lived through this past year when we saw the pandemic create a huge downturn in March, followed by a huge period of growth. So I hope this video was helpful. I hope it helped you maybe calm down a little bit and refocus on those investment goals of yours. Now, you guys know I love hearing from you, so please let me know, how are you handling red days like today? How do you keep yourself from emotionally reacting to downturns, and what are your strategic plans for hitting those investment goals in the future? Make sure to leave it in the comments down below. If you made it all the way to the end of today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Thank you guys so much for watching. I hope you have a great day despite all the red, and cheers.